When a surety underwriter wants to take a look at a contractor's financial statement, most people will know and they'll recognize the words working capital and net worth, and they'll know about a few basic ratios. Everybody knows you need cash. But if you want to take a deeper dive and really understand where an underwriter is going to focus in, they're going to focus on where you're investing your excess cash. From their perspective, like if you have it in the stock market, you're investing in someone else's business rather than your own. And they're going to look at your receivables. Are you collecting your money? Because cash is really what is king for them. And there are a lot of owners that aren't paying people very well right now. So they're going to want, on a quarterly basis, to take a look at your receivables and make sure that you're collecting them. Anything that's over 90 days, they're going to hit you on. And then the other most really key thing on the asset side of your balance sheet is your underbillings. Because from a surety underwriter's perspective, that's where the bodies are buried. That's where a contractor has the ability to hide things, or where there are things that can be messy, whether they're unapproved change orders or they're potential claims, where that money might not be collected ever, or it might not be collected quickly like it should be if it's considered to be a current asset. And then when you flip to the liability side of the balance sheet, the surety is going to be focused in on the kind of money that you owe and whether it's interest-bearing debt. So one of those ratios that they focus in on is your debt to net worth ratio. And if that ratio is high, like in excess of 3 to 1, if the composition of those liabilities are accounts payable, that gives them much less heartburn than if it's interest-bearing debt, where you have certain obligations to meet as, you know, a requirement every month for the next year or then years beyond it. So when I flip to the income statement for the financial statement, the key thing that the surety is focused in on there is operating profitably consistently. They don't expect you to make money every year, but they do expect you to make money consistently on an operating basis. And that means that you're making it right off the top through your business and not by the sale of property or equipment or whatever after the fact. And then the last component of your financial statement is your work in progress schedule. And the most important thing there is to know that your statement is most likely on the percentage of completion basis of accounting. So it's really important for the profit or loss numbers or whatever to be consistent throughout the course of the project, because the surety is going to look at those on a trending basis quarterly throughout the duration of the project. And if your profit numbers fade toward the end of the project, that's a really bad thing, because the percentage of completion basis of accounting gives you credit for the money that you're earning on those projects while they're underway. And if historically your profits fade at the end, then guess what? Your profits were overstated on the financial statement that they were using to base their credit on. So those are the things where sureties really do a deeper dive.